people come into precious metals, interestingly, for two reasons: fear and greed. People are flooding into gold because they're afraid in a bull market. When precious metals have moved, momentum traders come in, the greed traders.
Please join us for our next live stream Sunday, September the 8th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, September the 8th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, housekeeping. If you are new to this channel or you have not already done so, please do subscribe. Click on the bell to be notified of new updates, and do give us a thumbs up if you like what we do. We appreciate your support. Our guest today is Rick Rule, President and CEO of Sprott USA Holdings. He is also the founder of Sprott Global Resource Investments, and having survived 4 mining downturns and thrived in 4 mining upturns, Rick Rule is one of the best known and most influential people in the resource mining business. And we are delighted to have him here today as a return guest on SBTV. Good day, Rick, and welcome back to SBTV. How are you doing?
I'm doing very well. It's very nice to be back with you. Thank you.
Thank you. We're glad to have you back again. Rick, 2019, it's been excellent for gold so far, with the price of gold reaching 6-year highs. Now, I'm aware that you are very much a long-term investor, and you've often said that bear markets are the author of bull markets. Now, if you could, can you distill the cause for the rally in the gold price this year to one reason? What would it be?
Diminished faith in the long-term purchasing power of the U.S. dollar, particularly as expressed by the U.S. 10-year Treasury. The U.S. 10-year Treasury yields are now in negative territory after inflation. So the suspicion among global investors is that they will enjoy, if that's the right phrase, a diminishment of purchasing power by owning the U.S. 10-year Treasury. That does two things. It lowers the attractiveness of the bond relative to gold, and it also takes away the key reason not to own gold, which is the averted yield. If people could earn a positive yield owning the Treasury, that would mean that there was, in effect, capital rent to own gold. Jim Grant refers to gold now as the honest zero return, as opposed to the negative returns available in sovereign debt, including now the U.S. 10-year Treasury.
Okay, honest zero. Never heard that one before. But in your opinion, are you convinced that gold has entered a new bull market?
I am. That doesn't mean that what a speculator sees from here are stair steps to heaven. Bull markets back and fill, and so it's entirely likely that gold, and in particular gold stocks, will give up some of their gains and build a base and grind higher. What I really like, in fact, about the gold market this year is that it hasn't been a hockey stick chart.
Yeah.
You know, it hasn't been straight up, but rather it has just been grinding higher. And what I like even more is that the equities haven't rocketed higher based on gold strength. The subdued nature of this gain, to me, is evidence of market breadth and strength.
From your experience witnessing cycles of asset values from overvalued to undervalued, how long do you expect the next gold bull market to last, at least?
I'm too old to fall for that. A prediction that I could get caught up in is something that at age 66 I avoid strenuously. I'll tell you this. I've studied a chart recently. I'm not a technical analyst, but I've studied a chart, the Barron's Gold Mining Index. And it's very interesting. Going back 40 years, the up cycles have varied in length from as little as 9 months on technical rebounds to as much as 6 years, What's equally interesting to duration is the magnitude. The magnitude is truly stunning. Of the 11 upcycles that I studied on the graph, the worst of them generated 150% return in the equities. The best of them generated 1,200% return in equities. The question you're asking me, I think, has three parts. Are we in a bull market? And if not, when will it start? What is the likely duration of that bull market? And what is the magnitude? And I can say with confidence to all three, I have no earthly idea. What I can also say is that if you look at that chart, we are either approaching at or just off the bottom. The upside has somewhere between 9 months and 60 months. If you follow the thesis that you opened with, that bear markets are the authors of bull markets, the bear market that we've been through in the period 2011 to 2019 was at once very long and very deep. That would suggest that the recovery could be similarly long. Time will, of course, tell. What's more important in this context, I think, than discussing history is looking at the fundamentals. And the fundamentals really go, I think, to fiat currencies around the world in negative yield categories and their impact on the US dollar, because I really think that the most important variable with regards to the gold trade and the gold equities trade is faith in the long-term purchasing power of the US dollar, which the US government seems to be doing their very best to undermine.
Yeah. I mean, speaking of the US dollar, President Trump's recent tweets, he's calling on the Fed, where are you, Fed? And he wants a weaker dollar. When do you think we're going to start to see a weaker dollar relative to other currencies?
Well, I don't think you're going to see a weaker dollar relative to other currencies. My suspicion is measured against other currencies, both gold and the US dollar will do well in the next 18 months. The Germans sold 1.2, I think it is, billion euros worth of a 30-year negative yield bond. This may be the first time in history that a government has made a long-term promise that will come true. The German government looked at bond buyers and said, we absolutely, positively guarantee that if you give us money, we will give you back less than you gave us. This is a promise that a government can keep, but it's also a promise that a government can keep. It's also indicative of the fact that you lose less purchasing power in the dollar than you do in the euro or the yen. Doug Casey famously describes this circumstance as saying that the US dollar is the prettiest mare at the slaughterhouse. So the US dollar will be relatively rather than absolutely strong. But the promise of risk-free return, which is what fiat-denominated bonds are, is now, I think, concerning enough that we're beginning to see the generalist investors come back into gold because there's no reason not to, and there are solid reasons to, all of which are put up by debt.
Okay. I from watching one of your videos, I understand that precious metals assets share of investable assets in the U.S. today is less than 1%. How do you see the demand for precious metals assets with the renewed interest in gold that came with the recent price rally?
Well, let's talk about that arithmetic a little more,
Sure.
because that's math talking, not Rick talking, and math can be compelling, I think. The actual number is less than 0.5%. Precious metals and precious metals related securities comprise less than 0.5% of savings and investments assets in the United States. At the top of the epic bull market of the 1970s, in fact, all the way to 1981, precious metals and precious metals investments comprised 8% of investable assets in the United States. The 3-decade mean was about 2%. So if precious metals and precious metals assets attained their mean market share over 3 decades at 2%, demand for precious metals and precious metals equities in the United States, which comprises 24% of investable assets in the world, would quadruple. I'm not one of those who suggests that gold is going to win the war against the US dollar. I think gold is going to lose the war less badly. And I think that that will be potentially dramatic for precious metals and precious metals equities.
Okay, so if those numbers are true, which of course they should be, more people will be coming into gold. I'd imagine more people will be coming into silver as well.
That's another topic if you want to go there. Some people come into precious metals, interestingly, for 2 reasons: fear and greed. The gold trade that you're seeing right now is not momentum oriented. People aren't flooding into gold because it's up 14% off its lows. People are flooding into gold because they're afraid. Yeah. Later in a bull market, when precious metals have moved, momentum traders come in, the greed traders. And the people who are interested in precious metals as a consequence of cashing in on a bull market, maybe the equity investors, historically have done better in silver, and better yet in silver equities. Silver moves later than gold because the bull markets are always kicked off by fear but extended by greed. But silver traditionally has been more volatile to the upside and the downside, meaning in the bull market, it outpaces gold. But the best speculative asset class historically has been the silver equities, that is, leveraged calls on silver. That's because silver stocks are very rare. In down markets, they go almost extinct. High quality silver equities are rarer. There are probably 10 or 12 silver equities in the world that an experienced analyst could recommend with a straight face. And in a precious metals bull market, the rarest, most leveraged asset class ultimately moves the furthest. And one would have to suspect, if past is prologue, that when this bull market gets underway, for those people who have the courage and can handle volatility, the high quality silver assets will be the asset class to be in.
Wow. Okay, it's interesting. The last bull market from 2000 to 2011 saw many mining companies increase their capital expenditure to buy equipment and also to acquire new properties. When the bear market happened, many of these companies had to cut back their expenditure, close or sell off mines that were not economic to operate. With the gold price at 6-year highs, how big of an impact does it have on mining companies right now?
We're starting to see cost pressures in the mining business right now. We're starting to see cost pressures for a couple of reasons. The first is that the margins in the industry, particularly in Australia, have been strong enough that the company's costs of capital have fallen. And they're trying to make up for lost time. They are trying to invest to make up for the fact that they weren't able to invest in their basic businesses for the last 7 or 8 years. The other thing that you notice is that during lean times, companies mine material that has a higher average grade than their median return grade. This is a polite way of saying they high grade. And when they high grade, their unit cost falls relative to their income. When the gold price recovers, or the silver price recovers, when the metals prices recover, they go back to mining the median grade, except for that the median grade has gone down because they pulled out the high grade material. So costs will rise even if expenditures don't rise, because the industry has pulled material out of the ground that was higher than the average grade of their resources and reserves. So the cost pressures that you talk about will occur both in the context of investing, but also in the context of amortizing prior high grading.
Okay. We're on the topic of gold equities. I came across a recent video again from Sprott Media where you talked about investor psychology and asset valuation cycles using the Barron's Gold Mining Index, which we talked about a little earlier on. And It was really a gem of a video, and I encourage all of our viewers to go ahead and look at that video on YouTube and watch it as well and subscribe as well. But for our viewers who have not yet watched that video, can you explain why is it that you say you are either a contrarian or a victim?
Well, I think that video, the chart, shows it dramatically. Yeah. Most people react to a narrative when it has been demonstrated by price action. Von Mises described this as recency bias. Our expectation of the future is set by our experience in the immediate past. And if our experience in the immediate past is good, we become more aggressive. Or if our experience in the immediate past is bad, we become less aggressive. So ironically, when assets are overpriced, when the price action justifies the narrative that would cause us to buy them, we become more aggressive. In other words, we prefer overpriced goods because there's confirmation of the narrative that would cause us to buy them. Simultaneously, we avoid underpriced goods for exactly the same reason. If you look at that chart, the 40-year chart, you will see extraordinary swings in pricing and hence sentiment. One would think that what a rational person would do is buy stuff when it was cheap, buy stuff on sale, and sell stuff when it's expensive. But that's not what human beings do. It's ironic that when somebody is asking me for advice, as an example, and they have a stock that's, let's say it's doubled. Let's say it's a little stock. It's gone from $1 to $2, and nothing has changed internally with the company. Nothing is better or worse. It's just that it's gotten broader attention. A stock that's doubled in price with no change in fundamentals is arithmetically half as attractive, but we like it twice as much. And trying to talk somebody into selling a position that's doubled in price with no change in underlying fundamentals is very difficult. Yes. Similarly, if a stock is selling for $1 and it falls to 50 cents with no change in underlying fundamentals, the stock is arithmetically twice as attractive. But trying to talk an investor who has suffered a 50% loss into doubling his or her position in a stock that's fallen with no change in the underlying fact is extremely difficult. What it says is that we are rational human beings often when we go to a shopping mall and we look for a sign that says sale. We are irrational human beings when it comes to financial assets. And if you get nothing else out of the Barron's chart, look at the magnitude of the gains that you can enjoy when you buy goods on sale, and look at the magnitude of the losses that you avoid when the sector returns to favor and you harvest some of those gains.
Yeah, what you're saying, we see it all the time. Gold and silver go down when it's at a low price. Nobody seems to want to buy it, and then it starts going up, and then people start buying it at the top. And that's something it's hard to understand the psychology of that when it happens. So I appreciate you kind of explaining that. You said that while history might not repeat, it will almost certainly rhyme. And from your observation of long-term valuation cycles, would you say that precious metals assets have to rise from their current levels?
Have to rise? No. No. But likely to rise? Yes. Gold in particular has historically been a store of value and a medium of exchange. And I would suggest to you that the most important price determinant with regards to gold in the last 30 years has been, as I said, faith or lack of faith in the purchasing power of the US dollar as expressed by the US 10-year Treasury. The US 10-year Treasury has been in a bull market since 1981. So we're talking about an asset class that's been in a bull market for more than 35 years. The yield is, of course, inverse to the price. So the yield has fallen from 15.6 to 2, which is a different way of saying that the nominal price has risen over that period of time, manyfold. Now, I would argue with you that that bull market after 35 years is either over or very close to over. And if you buy the reciprocity argument, which says that gold trades inversely to the US 10-year Treasury, that would suggest that the bull market in gold is either begun or very, very, very close to beginning. And the reason, again, goes to arithmetic. The truth is that the US 10-year Treasury absolutely, positively, without fail, guarantees you a loss. Not a particularly attractive outcome for a saver like me.
Okay. Yeah, since we're on that topic, central banks around the world, they've been cutting rates in 2019, and markets are also expecting the ECB to go further into negative rates, as we touched on with Germany. Alan Greenspan recently came out and he made a comment that there is nothing stopping the U.S. from going into negative rates. What do you make of negative rates, which has turned the simple concept of borrowing and lending on its head?
Well, right now there's a disconnect between people's perceptions and arithmetic. Equity markets, as an example, have enjoyed what was first the Greenspan put and then the central bank put, knowing that if equity markets got in trouble, they'd cut rates to the point where the cost of capital for traders was very low and where the dividend yields relative to deposit yields were relatively high. So there's demand for lower rates. Lower rates, true, are also an income transfer or a benefit transfer from savers, people like your listeners who work hard, save their money, plan for their future, and try and look after their kids, to spenders. In a democracy, there are always more spenders than savers. So obviously, people will vote to steal from the prudent to subsidize the imprudent because there's more imprudent ones than there are, in fact, prudent ones. Now, ultimately, this ceases to work. Bond buyers, private bond buyers, eventually succumb to the arithmetic, the fact that they are guaranteed to lose money, which on the face of it is not a very attractive proposition. What has happened in the market for the last 10 years is that if nobody else buys the bonds, the central banks and the Fed capitalize them. They print up a bunch of money. That's called quantitative easing. And they buy this phony baloney paper themselves. Now, if you and I did this, it would be called counterfeiting. And you and I would become guests of the state in a penitentiary. If the state does it, it's called quantitative easing, and it's extremely popular. If this was so good, the state should authorize you to print up silver bullion bucks, which then you could translate like monopoly money into real goods and services. Obviously, it's only good if they do it, not if we do it. But the truth is that this circumstance can only go on for so long. Most people in the world ultimately understand how arithmetic works.
Okay. Hey, I'll be your cellmate anytime. You got a lot of good stories to tell, so I'm fine with that. No.
Let's do it this way.
Okay. Just for a little bit of clarity, why do you call U.S. Treasury bonds anti-gold?
I think they are anti-gold. I think that they represent faith in a collectivist fiat system. Bonds are a promise to pay. Gold is not a promise to pay. It's payment. It is an asset that isn't simultaneously somebody else's liability. If you own a bond, you are counting on the fact that somebody will pay you interest and that they will pay you principal. If somebody gives you gold for a transaction, they aren't promising to pay you. They've already paid you. The medium of exchange is the store of value. It could be argued that a well-collateralized bond from a solvent society represented a reasonable and just claim. While it wasn't simultaneously payment, it represented a promise that had a reasonable chance of being fulfilled. But we have a different circumstance with the Treasury now. Just at the federal level, our on-balance sheet liabilities exceed $22 trillion.
Yeah.
To help your listeners, that's 12 zeros after the 22. The off-balance sheet liabilities, the promises that we have made each other, exceed, by the estimate of the Congressional Budget Office, $100 trillion. So on the deficit side of the ledger, we have $120 trillion plus. How do we service or retire this debt? Well, with the government income, which is tax receipts minus expenditures. Unfortunately, that income is minus $1 trillion. So we propose to service a $120 trillion debt with an income that's minus $1 trillion. Congress would have us believe, I guess the voters would have us believe, that you can add a column of negative numbers and end up with a positive sum. It's a very interesting fairy tale, but to me, as a saver, it's also a wonderful reason to own more bullion.
Yeah, I hear you, Rick. Many who are positive towards paper assets often point out that physical gold and silver have a holding cost, like a storage cost. But if rates are cut too deep into negative territory, such that there is now a similar cost to cash, a storage cost of sorts, do you think physical gold will become more favorable to the markets again?
Two things are happening. The first is that the market for physical bullion, or bullion surrogates, our own Sprott physical trusts, various forms of digital gold, and the physical bullion market itself is becoming much, much, much more efficient. The transaction and holding costs in bullion 10 years ago were extravagant. They were extraordinary. They're much, much, much lower now. The market is much, much, much more competitive. At the same time that the bond yields have gone decidedly negative, not merely negative after inflation, but now in some cases in Europe and in Japan, nominally negative. This is a completely uncompetitive fight. And as long as it continues, I suspect precious metals will grind and then perhaps soar higher.
Okay, given that a high USD denominated gold price really shows the loss of purchasing power of the dollar, would we then see a higher nominal price of gold than in the 2011 bull market?
I'm making this next part up. You're asking me to do a projection. Okay. Buffett famously said that predictions tell you a lot about the predictor and not very much about the future. But my belief is, and this is just a belief, I'm not an economist, I'm a lender by trade. My belief is that the central banks have fewer levers at their disposal than they did in 2011. If we had a circumstance now, as an example, a liquidity squeeze of the type that we had in 2008, in 2008, there was lots of room to let real interest rates fall. There was still pent-up demand for income and bonds. So the tools that were available to suppress a financial crisis and ultimately to suppress the gold price are less abundant and less robust now. How far can you cut a negative interest rate? In many parts of the world, there were positive or decidedly positive interest rates, at least nominal interest rates, less so inflation adjusted. But those interest rates are now so much lower that one wonders about the fiscal terms that could be put in place to deal with a liquidity squeeze. If they attempt to deal with a liquidity squeeze the way they did last time, which is to pump more liquidity in the system and take the yields decidedly negative, I suspect that the gold reaction that you would see would begin to resemble the gold reaction that you saw in the beginning of the decade of the 1970s.
Okay. How do you think negative rates will affect the gold mines, the mining projects, the explorations?
Well, it's interesting. The very low interest rates that governments have been allowed to extort haven't fallen through to most of the gold miners. So the cost of capital, unless you are a very large investment grade credit, have not fallen much. The benefits of low interest rates have gone to more traditional asset classes. Certainly, if you are an upper income buyer of single family residential housing in the United States, the 30-year fixed mortgage 10 years from now will look like an absolute gift. They're giving you free money and you're advised to take it. Investment grade corporate credits, investment grade bonds, government borrowers have historically low costs of capital. But most of the gold mining industry isn't yet an investment grade credit. And the credit markets have bifurcated. So the cost of capital associated with non-investment grade gold miners is still quite high.
I have one question for the average Joe. Let's say he's interested in investing in mining stocks. How does he go about doing it?
Well, my preference would, of course, be that he open an account with Sprott and we help him. But the truth is that what the average investor needs to do is begin their portfolio with the highest quality names. What you learn from that Barron's chart is that everybody is seeking alpha, but the market beta is so extraordinary that if you just capture the beta, and in particular, if you can capture the beta with the best names so that you eliminate half the risk, the idea that in a year and a half you can make 150 or 200% on the best names means that the way that most investors should go about constructing a portfolio is to take at least 75% of their equity money and put it in the best names that they can, and then speculate with 25%. But even in the speculations, your listeners need to be taught, they need to understand that there are probably 1,500 junior mining companies in the world, and probably 150 of them harbor all of the value. So 10% of the listings harbor all the value. There's so much money to be made in bull markets, that all you really have to do is avoid the most egregious mistakes. And that's what the listeners have to do. The problem is that the listeners get attracted to a narrative. Somebody says, if this happens, this happens, this happens, and this happens, this stock could go 30 for 1. The speculator hears the 30 for 1 and forgets about the this, and this. The probability of that event is very low. And that's what investors need to deal with.
Yeah, okay. I guess it's because we have guys, they buy the physical bullion. But when it comes to the mining, you're buying management in a sense also. And
absolutely.
Right?
Absolutely.
And I think this is where they may want to get in, but they're just unsure. And so it's great that there are guys like you where they can go to and to understand it.
Well, my hope is after 40 years in the racket that most of the worst mistakes that I can make, I've already made. Hopefully, I can help new speculators avoid the worst of the sins of my past. The other thing is that I believe personally that you start a precious metals portfolio with precious metals. The first thing you do if you think the gold price is going to go up, you buy some gold. Mm-hmm. That's the anchor of a gold portfolio. Similarly, if you think that silver is going to go up and you're more speculatively inclined than insurance inclined, you buy some silver. I care less, frankly, about the form that they buy it in, although I would prefer it said Sprott. The important thing is if we're going into the circumstance that I suspect both you and I believe we're going into, you begin those portfolios by buying the asset itself, not a proxy for the asset, which is the share.
If, let's say, gold is at 5,000, what is Rick Rule doing at that point? Is he buying more? Is he selling it? Is he hanging on to it?
I will always have some gold in my possession because I regard it as insurance. Arguably, being the largest shareholder of Sprott and a large investor in the mining business, I wouldn't need to own any gold because my life is so leveraged to gold as it is. That notwithstanding, I'm an old, rich man. gold enhances my sense of well-being. I sleep better owning it. So irrespective of the gold price, I will always own some gold. Certainly, if we went to a circumstance where the gold price was 5,000, but the interest rate paid on a U.S. 10-year Treasury was 6 or 7, with the underlying inflation rate at 3, I would sell some gold because it would be relatively less attractive. Before I sold my gold, I would also certainly be selling some or most of my gold mining stocks, because with gold at $5,000, ironically not as cheap as it is today at $1,500, the gold constituency would be enormous. And we would be able to look at the 40-year gold mining index chart from Barron's Magazine from a lofty as opposed to a low position. Remember that buying low and selling high involves two actions. It involves buying low and it involves selling high. So certainly for the investor, rather than the sort of insurance owner in gold, you need to sell some when the prices go high in order to maximize your benefit.
Okay, Rick Rule, can you let our listeners know more about Sprott Global, what Sprott Global does? And I believe you have some events coming up.
We have some events. We have a lot of things to talk to you about. Sprott is a publicly traded investment manager focused on natural resources and precious metals. With the recent acquisition of the Tocqueville Group of mutual funds, our total resource assets under management now exceed $14 billion, which we manage on behalf of 200,000 something investors worldwide. The specific thing that we would like to offer your own listeners is an absolutely no obligation portfolio ranking and review. If your listeners will send me their natural resource portfolios, importantly, with names and symbols in the text, not as an attachment that an old man can't open, I will rank those companies on a 1 to 10 scale and send them back by return email. Send me your natural resource portfolio at rankings, rankings, at sprottglobal.com. That's rankings at sprottglobal.com. On an absolutely no obligation, I will rank your portfolios and return it to you via email. We believe at Sprott that investor education is the most honest and effective form of advertising and marketing. So we're going to provide you a service in anticipation that the consequence of that service is that you will look with favor on Sprott.
Okay, Rick, we appreciate that offer. Is there anything else you would like our viewers to know or to keep in mind?
Well, of course, we would like them to subscribe to our YouTube channel and to visit us at Sprott US Media. And we would also like to continue this dialogue with you. Your viewers' interests are probably best expressed by the person who knows them the most, you. And we would like to continue this dialogue. It's fun for us, and it allows us to channel the knowledge of the entire Sprott organization, the 180 employees worldwide, expressed through me, to you. It's been a fun process, and I look forward to doing it again.
Okay, Rick Rule, thank you very much. We appreciate the time you've given us, and as always, it's a pleasure speaking with you.
It's always a pleasure. I think any business that has silver in the heading is doomed to do well over the next 3 or 4 years. So congratulations.
We wish you all the best too. I think the mining sector is going to be looking pretty darn good very, very soon.
Agreed. Thank you.
All right. Thank you, Rick. Take care. Appreciate it. That was Rick Rule, President and CEO of Sprott USA Holdings, sharing with us his invaluable insights and the opportunities in the gold and resource industry. To find out more about Sprott Global, please visit their website, sprottusa.com, and do find the SBTV podcast on iTunes and Spotify.